Welcome to the ARMR Report. I'm your host, Brett Rosenthal. This is a show about stock market investing in the millennial age. Thank you for joining me. This is a live trading desk. We're in the cockpit. I'm surrounded by computer screens. I use my own personal capital to invest in the stock market, and I manage assets as well. I've been doing this 30 years as a professional fund manager. And I just thought I'd start this YouTube channel and my podcast back in August to share with you some of my knowledge and to express the importance of understanding that the world has changed. This is not your dad's stock market, certainly not your granddad's. We have, since 2008, changed course after that financial crisis. So we have a combination of two main factors coming together. We have central banks excessively intervening in the economic cycle and in equity markets and in credit markets in a manner never seen before in history. And we're seeing at the same time the rise of the machines and algorithms that have a major impact on trading activity intraday and over multiple days, and it can affect your buy and hold positions as well. And so I am going to try to share with you live information directly off our desk every day, 12 o'clock, to help you deal with the new world we're living in and be aware of it. Passive investing is over. Passive investing ended the minute the Fed started raising rates and reducing its balance sheet. That's why 2018 has been a terrible year. We're in a bear market. 2019 doesn't look much better until such time as the Fed and central banks start adding liquidity. Will we ever go back to that decade of central bank intervention to such a degree? I don't know. Maybe not. Maybe not unless we have another 50% correction in the stock market and everyone's panicking and then the central banks step in again. Who knows where that level is? And since you don't want to have your net worth affected in such a negative way, you want to use algorithms, put them on your side to protect your capital and still capture upside when appropriate. I like to start the show out by focusing on our top 5 algorithms for the big indexes, right? We use the S&P and we use the exchange traded funds for this part of our investing process. We use the S&P, SPY, the triple Qs, QQQ, the diamonds, DIA, small caps, IWM, and the momentum index, MTUM. Those 5 indexes and the proprietary algorithms we've written for those indexes drive all of our investment processes and our thinking. You can follow our model portfolios and the way they're constructed on our website, rosenthalcapital.com. We have a affiliation with Interactive Brokers, and those model portfolios, anybody who has an IB account can link their account to those portfolios and start putting the power of algorithms into their own investment process. On our homepage, we update what those portfolios look like. So you can go look at that at rosenthalcapital.com. Right now, our real-time risk-on, risk-off monitor is risk-off across the board. So we're carrying 85% cash through U.S. Treasury bills. We have 15% of our portfolio long one focus group, and that's the precious metal space. But today what I want to do is go over what the top 5 algorithms are telling us. I want to go over rule number 27 in our rules of the road. We've been doing this 30 years, and I'm building a list for you of all the rules that I've learned, I've hard fought, learned, and I've bled for. I'm going to share it with you. Rule number 27, you can go look on our website, click on algorithmic research, and you'll see what rule number 27 is. You'll see rules of the road. I'll go over that, and I'm going to go over how to day trade the extreme volatility of a bear market. So let's start with the big 5 algorithms. We're still in a risk-off position. We've been in a risk-off position since December 4th. Nothing has changed that. Today's a big day. We've had 2 up days in a row. I imagine if we have a 3rd up day, our algorithms will tell us it's time to put some risk back into the portfolio. I won't know that until the end of the day. I'll try to update our website. We'll go to our real-time risk on, risk off monitor, and I'll tell you if things have changed. And of course, I'll go over this on Monday, 12 o'clock, if there is a change. At the moment, the market is in position for a change, telling us it's time to add some risk. What that will mean for us, just because our algorithms go from risk off to risk on, doesn't mean we put 150% of our money to work, or even 100% of our money to work. Depending on the aggressiveness or the conservativeness of the account, and you can see our 3 linked portfolios, those models, we'll have more or less committed at the end of the day to the big indexes. When we're in a bear market and we've had extreme volatility and the 200-day and the 50-day moving average are in downtrends and we're trading below those moving averages so that risk is at its extreme. If we get risk on across the board with our algorithms, that will mean we'll put capital to work, but at a reduced rate for all 3 of our model portfolios. When we're in a bull market, when the 50-day moving average is in an uptrend, when the 200-day is in an uptrend, when the price is above those averages and we get a risk on signal after a short-term sell-off or a pullback, we will put on anywhere between 125 and 200% market volatility into our accounts to capture upside and build alpha. This is the exact mirror image, or I should say the 180-degree reverse image of the market right now. The 50 and 200-day are in downtrends. The prices of these indexes are below both of those moving averages. Risk is at its extreme. I always try to put us on the right side of probability and statistics and also look at reward versus risk expectations. So when the algorithms tell us it's time to put risk on, it means the probabilities are in our favor that the market will go higher from here. But what is the reward potential? Well, when you're in an uptrend and you're in a bull market and you're breaking the new highs, the reward potential could be unlimited. You're in a momentum market. When you're in a bear market and you've had extreme downside selling and you get a risk on signal, the reward is going to be a lot of overhead at those key moving averages. And therefore, the reward from here is not unlimited. It's very obvious where these indexes could go to just work off this oversold condition, but then there'll be a lot of overhead supply. And that kind of limits the upside, which means it limits the reward on this entry signal. So it behooves us to put capital to work, but at a reduced rate because the reward expectation is not big enough for us. So be advised. We get a risk on signal today, and let's launch into what rule number 27 is. Go look at the website, rosenthalcapital.com, click on algorithmic research. You're going to see a blog post about rules of the road. I'm building this list for my kids, actually. I have a 5-year-old son, 2-year-old daughter. And when they're ready for this information, however old that is, when they start to show an interest in what dad does, I'm going to share this list with them. But as I compile the list, I'm going to share it with you. Rule 27 is an important rule in a downtrend. 2 up days in a downtrend means absolutely nothing to me. Statistically speaking, completely normal. Whether it's a bear market or a bull market, it doesn't make a difference. When the market's in a downtrend and it has 2 up days, that's totally normal in the downtrend. It means nothing. 3 up days means a trend can be changing. Today's day 3. We had a huge reversal day a couple days ago. Then we had a really big reversal day yesterday. And now we're pressing higher today. If the market closes up today, that'll be 3 up days in a row. And that would add a lot of validity to a risk-on buy signal that may occur across the board in our indexes today. If the market sells off hard today into the close, then that would suggest to us this was just a typical bounce off of the low, and a better entry point for risk will occur over the next couple of weeks. So I'm really curious to see how this trades. But 2 up days means nothing, and percentages means nothing. I went over this yesterday on the podcast, and I highlighted all the bear market rally days going back to the 1930s, 1929, going back to 2008 and 2001. You had 1-day wonders, huge up days. 2-day wonders, percentage-wise, big moves. And a week or two later, a month or two later, the market was down huge. It meant nothing. In fact, I really don't like it. It's a bad way for a bear market. Bear markets usually don't end that way, with major up moves off the low, unless it occurs after a consolidation period and a reduction in volatility. It's not happening right now. We have massive volatility, massive jumps up, that's not how a bottom is made. That's a bear market bounce. So if we get risk on today, let me just wrap up with this thought. If we get risk on across the board on all of our indexes, with our algorithms, we may put some money to work. Depending on how the market closes today, will determine how much we put to work, if we put it to work at all. Because bear markets, we're looking for paw prints. We're trying to see, is this a bear market? Or is it the end of a bear market? How does the market behave? 2 up days means nothing. 3 up days means maybe a trend change. Unfortunately, the paw print continues in the small cap index. IWM continues to underperform the rest of the indexes. Today is another example. All the other indexes are up more than IWM. So the small cap index continues to underperform, which is a major paw print, particularly in this bear market. We called the top of small caps on the 24th of September. Just go back, scroll, go to our website, Rosenthal Capital, if you haven't done this already. Scroll down to the bottom of the homepage. You'll see all of our podcasts. Go back to the 24th of September. Listen to that podcast. We said risk is on the rise. Small caps have been stopped out, as have mid caps, and that's very dangerous for the market. It's the canary in the coal mine. And so if the market's really bottoming, I would expect small caps at the very least to perform in line with big caps. And unfortunately, in the last 2-day, 3-day rally, small caps have underperformed, suggesting this is just a typical bounce off of a major oversold reading, as opposed to the beginning of a whole new bull cycle. Okay. Before I get to the day trading of the extremes, I'm going to show you how we day trade market volatility in extreme markets like this. Before I get there, I just want to update real quick the cannabis stocks. You know, I'm a big fan of the pot stocks. Another paw print is that what I think is a very unbelievably great investment opportunity going forward over the next 6 months to a year to 3 to 5 to 10 years is the marijuana industry. I think you're going to have a huge opportunity to increase net worth in that sector. It's a fundamental story. It's at the very top of our whiteboard, but it's also at the early stages. And so when you're in a bear market, early stage developments where industries are experiencing a paradigmatic shift, and institutional investors are starting to discover the industry. In a bear market, that group doesn't perform well. And it's been leading the market on the downside. I mean, when the market has these big bounce days, marijuana stocks do nothing. I'm not frustrated by that. That's just another paw print. I'm not long the MJ, the index, at all. I don't have any of those stocks in my portfolio. I'm looking to own them. I'd love to own them. But just like the small cap index, there's no institutional sponsorship for them yet. I think there will be over the next 6 to 12 months. I want to get involved before that wave of institutional investment capital comes in. But in the midst of a bear market, it's not coming in. And it's another way for me to judge these rallies. If this rally in the last couple of days was for real, I would expect small caps and the marijuana stocks to participate. They're not. That's a negative paw print for the market. But anyway, I am compiling a blog post that I update constantly. Again, rosenthalcapital.com. You can click on algorithmic research. You'll see this blog post about cannabis stocks, marijuana stocks, pot stocks, hemp stocks, whatever you want to call them. It's a major investment theme for us. We're doing research right now. We're doing our homework, and I'm updating that blog post with any relevant information that comes out. And today, of course, is the story that symbol APHA, Apria, got an investment or a hostile takeover bid from another company. At first glance, I write this on our blog post. It looks like good news, and so what's more important to me is how does the cannabis industry respond to the good news? If good news keeps putting these stocks down, then we're in a bear market, and most of the stocks are down today. MJ is up 1.25%, right now. But all the important names, Canopy's down, Kronos is down, all the names that I've, Telray's up a little bit. But most of all, this news hasn't had any effect on these stocks. So that's kind of a bear market paw print. However, I read a very interesting post on Seeking Alpha, which I also put on our blog post, so you can click on it and read it, that suggests this is not really a takeover bid at all. It's kind of a bit of shenanigans. And maybe that's why these stocks aren't going up. It's not really good news, but it is something to keep your eye on. So take a look, read the stories. It's another, I think we're going to see a lot of takeovers in this space, a lot of consolidation. And this is going to draw in institutional sponsorship, because in order to go through all these takeovers, all this M&A, who do you need? Investment banks. And the more investment banks that get involved in the marijuana space, the more institutions get drawn in. And so you'll see on my blog post about cannabis the story that Royal Bank of Canada is starting to get into the investment banking field for the cannabis companies, the first major investment bank. There won't be the only one. That's very positive. It's one that's on the top of our whiteboard. All right, let's get to the order of the day that I think you all may have been waiting for, and that's how to day trade extreme market volatility. Before I get into it, please go to our Twitter feed. You can also find me on StockTwits, RCM Trading. Okay? On the Twitter feed, hashtag ARMR Report, I have posted 2 chart patterns that you can look at while I go over this conversation. So take your time, go to Twitter, go log on, go pull up hashtag ARMR Report, go look at the 2 charts of the S&P 500, SPY, that I'm going to be talking about right now. I'm going to give you a minute. Okay, are you there? I'm going to go take a peek myself. Okay, I'm going to take a look at the charts. Oops. There we go. Okay. What we've got are two charts of the S&P, SPY, symbol SPY. We had two huge day trading days on our trading desk, yesterday and the day before. And we told you about it on Twitter. So if you're following us on Twitter, maybe you guys joined me in this. I hope you did. I hope you made some money. Just going to go over step by step here what we look for in an extreme volatility market. First of all, I'm not a big fan of day trading. I don't do it every day. You're going to hear me say this over and over again. I look to put myself on the right side of probability and statistics, and I like to, on any investment idea, whether it's day trading or long-term buy and holding, I like for the reward to be big enough for the risk that I'm taking. So on a normal day with normal volatility, to me, the reward's not worth the risk when it comes to day trading. I mean, I've got algos that trade an intraday basis and let them do it. And okay, we make some money there and it's okay, but it's not my favorite way to run money. But in extreme volatility days, the reward is so enormous that it makes the risk worth it. Exhibit A and Exhibit B are on my Twitter feed. I hope you guys are there. Take a look. Click on the chart. Let's go over yesterday's trade, which should be the first chart. What you're looking at, let me just give you a quick rundown. The black dots are the VWAP, our Rosenthal Capital Management VWAP. All of this is proprietary technology. This is part of our algorithms. The black lines, the black dotted lines, the VWAP. There are lines above and below the VWAP that you can see, which are standard deviations 1, 2, and 3 above and below the VWAP. The grid line that you're looking at are Fibonacci extensions, again, RCM Fibonacci extensions, so not off-the-shelf Fibonacci, but our own calculations incorporating volatility. And if you look off to the left-hand side, you're going to see the closing price of the 27th, or this is the 26th, okay? And on the 20, and so what you're going to see yesterday is a gap down, and it moved down to the previous day's VWAP. And I put out on Twitter when we hit that price that this is the location that will make or break the market. The market will either hold here and go a lot higher, or it will break here and the end of the day is going to be ugly. This is the location. Now, why did we trade it? Look at the gold box. You're going to see 3 arrows. Okay? What we look for on extreme volatility days is for the market to be, and we're going long here, we're looking for a big down day. We're looking for at least a big down hour. So we need to see at least an hour or more of selling. So we're looking for a crescendo, a lot of selling, and then a crescendo down. We're looking for a new low on the day on a volume spike. And that's what happened where the first green arrow is. Then we buy the market if it closes a bar above the high of that volume down bar that made a new low on the day. So what we're identifying is a crescendo selling for at least an hour or more. In this case, it was a couple hours. And then that crescendo down on big volume that freaks everybody out. Everyone thinks the end of the world's coming, and a reversal. We take out the high of that bar, we get long. We sell half the position or stop half the position if we take out the low of the bar we bought, and we sell the other half if it takes out the low of the volume reversal bar. Once it starts running, we book some profits at the black dotted line because that's our VWAP. We always book some profit there. We raise our stop at that point to the bar that hit the VWAP, okay? And then we let it run. And we don't mess with it unless it takes out the low of a couple of bars ago, or we have 3 bars down in a row, and then we start booking some profits. It led to a huge day. Now go look at the next chart. That was 2 days ago. Market gapped up in the morning. It sold off for more than an hour. It set up a double bottom at the previous day's low, previous day's closing price, which is a great location to look for reversals. You'll see another in the first green arrow in that gold box. You'll see another low, new low on volume, and a couple bars later, we close above the high of that low, and we ripped higher the rest of the day. And you all know, I walked you through this day. I was telling you we're buying calls. 11:06, I said we're buying calls on the S&P. We had a huge day. We're up 129% on it. That's how you trade extreme volume days in the stock market. You look for at least, so let's just recap before I let you guys go here. You look for at least an hour-long selling period that then crescendos on volume, that makes a new low on the day, scaring people. And when you take out the high of that scary bar, you put your long position on. And you do it because the reward is so significant, if you're right, that the risk is worth it. You cut your loss quick, because when these trades work, they work immediately and they never give you cause for worry. That's how you day trade an extreme volume day. I hope it's been helpful. I look forward to talking to you guys on Monday. Have a great day. Tune into our Twitter feed later today, and I'll update our real-time risk on, risk off monitor and how we're handling our investments if there's a change to be made. And of course, we'll go over that on Monday at noon. Have a great weekend, guys.